let's go ahead and talk a little bit about Chuck Hughes. Chuck Hughes is going to talk to you a little bit about finding low risk entry points. Chuck, the thing I like about him is he's got a very, very straightforward strategy. He loves to trade options. He's been doing it for a while. He's a number of years. He did it. He did it full time. He'll talk a little bit about more about his heritage, but his methods are very, very solid, just like everybody else today. And let's go ahead and bring him online. Chuck, I'm going to go ahead and unmute your microphone, so just be careful about that. And I'm going to go ahead and turn on your screen as well. So, Chuck, can you hear me?
Yes, can you hear me, Jeff?
You sound awesome. I can hear you. We have had
Okay, good.
very few technical difficulties today. You'll be happy to know that. Unless you
Okay, good.
believe we're due for one, because then it might be you.
Okay.
All right. I can see your screen, and it's the non-expanded view, but I'm sure you're starting the presentation right now. So,
Yes, yeah, I'm gonna switch over to slide mode here. My control panel's on the left-hand side, so it's blocking the, let's see what I can do here.
you can hit F5. That'll work too.
Okay.
All right, I'm out of your way. Go.
Okay, good. Good morning, everybody. This is Chuck Hughes. It's a beautiful day here on the central coast of California, and I'm glad to be here to present our option spread trading strategy. We've been trading options for more than 30 years, and we prefer to trade spreads over directional trades because there's a lot of advantages to trading spreads, which we'll go into. I'm trying to advance my slide here. Let me see. Oh, here we go. Okay. Okay, so we're going to look at stock and option spread trading versus directional trades. And when you buy a call option, the underlying stock must increase in price above the strike price of the option at expiration, or you will incur 100% loss of the option premium. So that's what you're facing when you're trading options and you're buying calls or puts. You always run that risk. If the stock doesn't close above that strike price, then you incur a 100% loss. So if you have a string of losing trades like that, those 100% losers during a market correction, then your trading account could be wiped out. So we try to avoid that by trading spreads. And option spreads can profit if the underlying stock increases, decreases, or is flat. So this provides a big advantage over directional trades and increases your odds of being a successful trader. And of course, spread trades can increase the percentage of winning trades, and they can help maintain your positions during market corrections without being stopped out of your trades. Now, during the recent market correction, we exited a few of our trades, but we kept probably 90% of them because we had the short component of the spread, which profited as we went through the market correction and the underlying stocks and ETFs went down in price. We were able to maintain our positions during that correction. And now with the market rebounding, of course, we'll take advantage of that with the spread trades, because the long side of the spread will profit as the market recovers. So we're in good shape after this recent market correction trading spreads. And as we'll see shortly, when you leg into an option spread, that can even guarantee a profit for your trade, regardless of the price movement of the underlying stock. Now, we trade four types of spreads. We trade the profit guard option spreads, the profit guard stock spreads, debit spreads, and covered calls. Now we trade profit guard spreads on stocks and ETFs that have low volatility and low cost option premiums. And a profit guard option spread is initiated by purchasing an in-the-money call option and purchasing an at-the-money put option. And profit guard stock spreads are initiated by buying 100 shares of a stock or an ETF and purchasing an at-the-money put option. And profit guard stock spreads are also known as married puts. Now, when you buy a put for protection on stocks or ETFs with low cost option premiums, that reduces the cost of the put protection. And normally, if we buy a stock and buy the associated put, the put will cost anywhere from 3 to 5% of the stock price. So that's the insurance premium you pay to limit your risk on a stock trade, usually around 3 to 5%. And we usually trade profit guard spreads using options that expire in 1 to 3 months. So we're not short-term traders. We don't watch the market during the day. We normally just look at our positions once a day just to see how we're doing, if there's any potential closeouts of the spread. But we're intermediate term traders. We don't watch the market during the day, and it takes very little time to monitor our positions. We also have option calculators that allow you to calculate the profit potential for profit guard option and married put spread trades before we take the trade. So before we take any option trade, we use our option calculators to calculate the profit potential and risk of the trade before we take the trade. We also trade debit spreads and covered calls on stocks that have rich option premiums. And the short leg of a debit spread or a covered call is initiated by selling to open a call option. And debit spreads are initiated by buying an in-the-money call option and selling to open a call option with a higher strike price. And of course, covered calls are initiated by buying 100 shares of a stock or ETF and selling to open an at-the-money call option. And selling calls on stocks with rich option premiums is more profitable than stocks with low premiums. So we like to focus on the stocks and leveraged ETFs that have high option premiums, because when you sell that premium, the time value portion of that premium goes to zero at option expiration, and of course that's profit if you're short that call option. And we normally trade debit spreads and covered calls using options with 1 to 3 months until expiration. And for diversification, we also will trade longer term spreads using leaps options. And most debit spreads cost between $600 and $800. And you can trade a portfolio of debit spreads in a $5,000 trading account, and your risk is limited to the cost of the spread. And debit spreads with rich option premiums typically have a 25 to 35% profit potential at option expiration. So we'll look on the option calculator, we'll look to get about a 25 to 35% profit potential when we initiate the spread, and we can usually do that if we focus on stocks and ETFs with rich premiums. And we'll look at our option calculator shortly that allow us to calculate that profit potential for debit spreads before we take the trade. In covered calls, we normally look for a 10 to 15% profit potential at option expiration. And again, that's for options that expire about 1 to 3 months out. And we also have an option calculator that allows us to calculate that profit potential for covered calls before we take the trade. So let's discuss the trade selection process for spread trades. So our spread trades always start out with our trade selection process, and we call it prime trade select. And step one is to determine the price trend of a stock using the 50 and 100-day exponential moving average system. Step two is we select a low risk entry point using the Keltner channel. So we'll look to purchase a stock or ETF option if it's in a buy signal using the 50-day and 100-day EMA system. We wait for a retracement to the middle or lower Keltner channel before we make an entry, and then we use what we call the 1% rule to select the option strike price with a high probability of success. So the EMA trend following system determines the price trend, and the goal is to quantitatively measure the buying and selling pressure of a stock. And a stock is on a buy signal when the 50-day EMA is above the 100-day EMA. And this allows us to follow the trend instead of trying to predict the trend. And it allows us to use a system instead of emotional decision making. We've been using trend following for more than 30 years. And our trend following system, the 50-day, 100-day EMA system, worked well in the 2002 and 2008 bear markets when we were heavily short options during those bear markets. We had both put option purchase trades, we had bearish debit spreads, and we had bearish profit guard trades. So we went through those two severe bear markets, and we were profitable with our short positions. And we used prime trade select to select those short positions. So it works both ways, both in bull and bear markets. And step three of prime trade select is we use the 1% rule to select the option strike price. And when you use that 1% rule, the stock only has to increase 1%, and you're going to break even on that trade and start profiting. So that's an important part of prime trade select, is selecting that stock price, that strike price. And when you use the 1% rule, the option trade will profit $100 for each point the underlying stock increases. So if the stock goes up 1%, we break even, start making money, and every 1 point increase will result in a $100 profit on the option trade. So we try to set up these option trades so we have a high probability of success. Now there's a MetaStock module for prime trade select that will generate a list of stocks and ETFs that are on a prime trade select buy signal. So that's the first step in setting up our spread trades, is we use prime trade select to select the stock that we're going to trade. And we can initiate the spread by entering the long and short position simultaneously, or if we purchase a stock or a call option and we have a profit in the trade, we can leg into a spread at a later date. So we use both methods to enter spreads. We enter both simultaneously, and we also will enter from a directional trade if we have a 30% profit in an option trade. We always enter a spread trade to protect those profits. So I'm going to show you a snapshot of our brokerage account, and it shows our open trades, and we had, when we took the snapshot, we had $901,000 in open trade profit. So here's a listing of the spread trades that we'll be discussing today. This lists the stock or the option here, our entry price, the current price, and our total gain and percentage gain or loss. So when we took the snapshot, we had a $901,000 profit and a 48% average return. So the strategies are working well. So let's look first at bullish debit spreads. And bullish debit spreads can profit if the underlying stock or ETF is up, flat, or down at option expiration. And the way that we initiate a bullish debit spread is we buy an in-the-money call option, and then we sell a related call option with a higher strike price with the same expiration date. And as we mentioned, the call purchase and the sale can be done simultaneously, or you can purchase a call and then sell a call at a later date to leg into the spread. And we trade, we initiate the spreads both ways. Some we'll do a simultaneous entry, and we also will leg into a spread at a later date, and this diversifies our portfolio. So with a bullish debit spread, the call option that you purchase will profit if the price of the ETF or stock increases, and the call option sold will profit if the price of the stock or ETF decreases. And your risk is limited to the cost of the spread. We normally initiate spreads with 1 to 3 months until expiration, and most spreads cost between $600 and $800, depending on the cost of the underlying stock. And we can trade a portfolio of debit spreads in a $5,000 trading account, and your risk is limited to the cost of the spread. Now, with bullish debit spreads, the full profit potential of the spread is realized if the underlying stock or ETF closes at or above the strike price of the call option that you sold. So if you sell an at-the-money call or an in-the-money call, the price of the underlying stock does not have to go up at all, and you're going to realize the full profit potential of the spread. So that gives you obviously a huge advantage if the underlying stock is flat. Then you're going to realize if it's an in-the-money call spread, the underlying stock is flat or even declines, you're going to be able to realize the full profit potential if the stock closes above the short call option. And most of the time, we can realize a 30 to 40% return if the underlying stock is flat at option expiration, and also profit if the stock is down as much as 10%. So again, with these spreads, unlike directional trades, the directional trade, the underlying stock has to go up or you're going to lose money. If it doesn't close above the strike price, you're going to lose 100% of the option premium. So with the spreads, the stock can be flat or even down as much as 10%, and we're still going to profit. So obviously you're going to have a much higher probability of success as a trader if you can profit when your stock is flat or down. And as I mentioned, debit spreads work just as well in down markets, and during the last two bear markets, we had bearish debit spreads, and we were profitable during those bear markets. And bearish debit spreads use put options. Let's look at a few recent debit spread examples using the simultaneous entry where we purchased an in-the-money call and then sold a call with a higher strike price. So this was done simultaneously. And these spreads we'll look at expired in 1.5 to 2.5 months out. SOXL is the symbol for the leveraged semiconductor ETF. SOXL was on a prime trade select buy signal, and our brokerage confirmation shows that we bought the SOXL February 140 calls at 35.90 and sold to open the 150 calls at 29. So this created a debit spread. And at the time, Soxal was trading at 166 when the trade was initiated. So we bought the 140 call and sold the 150 call. So this was an in-the-money spread. And we paid $35.90 for the 140 call, sold to open the 150 call at 29. So the net debit was $690. So this spread costs $690. Now, in the money spreads give us more downside protection and a higher probability that the trade will be profitable. And in the money spreads can profit if the underlying stock or ETF is down as much as 10% at option expiration. And we designed a series of calculators to calculate the profit potential for option trades, including debit spreads. And the calculators will calculate the profit potential for the trade based on the price change in the underlying stock or ETF at option expiration. So we use the calculator to calculate the profit potential for the Soxal trade before we took the trade, and it will calculate the profit potential for a trade assuming various price changes in the underlying stock at option expiration. In this example, from a 10% increase in the stock price to a 10% decrease in the stock price. So you put in these assumptions for the change in the stock price, and then it'll calculate the profit potential for the spread trade. So at the time, Soxal was trading at 166.72. We bought the 140 strike call, which was an in-the-money call, at 35.90, sold to open the 150 call at 29. So let's take a look at the profit potential for this trade. And the bottom row here lists the percent profit potential, and the second from the bottom row lists the dollar profit potential for this trade. So we can see if Soxal was flat at 166.72 at option expiration, the trade would realize a $310 profit and a 44.9% return. Or if Soxal was up at all at option expiration, we would realize the 44.9% return. And even if Soxal was down 10%, we would realize the 44.9% return. So in this example, you could see from our brokerage statement, based on the prices we paid for the 140 strike call and sold the 150 strike call, that this trade has a 44.9% profit potential if the ETF is up or even down 10% at option expiration. So again, if the Soxal was flat or up, we're going to realize a 44.9% return, and if it's down as much as 10%, we'll still realize the 44.9% return. So profiting when your ETF or stock is flat or down 10% gives you a much higher probability of success as a trader. And as I mentioned, the in-the-money spreads give us more downside protection and a higher probability that the trade will be profitable. So we like to focus on in-the-money spreads because they have a higher probability that the trade will work out. Now we also leg into debit spreads, and we use Prime Trade Select to select a trade, and it's produced a lot of winning call option purchases. So what we do is, if we have a money management rule, if we purchase a call option and we have a 30% or higher profit in the call option purchase, then we'll sell to open a call option with a higher strike price at a later date to establish a debit spread, and this is known as legging into the debit spread. And when you sell to open a call option, your trading account receives a cash credit for the option premium that you sold. So if you sell to open a call option with a 4-point premium, $400 in cash is credited to your brokerage account. And if you purchase a call option and that call option increases in value, the sale of the call option at a later date generates a cash payment, and that cash payment will increase the profit potential of the existing call option purchase by as much as 100%. And will also provide downside protection in the event the underlying stock declines in price. So when you leg into a spread, you accomplish two things. It increases the profit potential of the existing call purchase and provides downside protection. And it also reduces the cost of your option purchase, and then that will reduce the risk, your dollars at risk, and we'll show you an example of that. So with a bullish debit spread, the call option that you purchase, of course, will profit if the price of the underlying stock or ETF increases, and the call option that you sold will profit if the price of the underlying stock or ETF decreases, and your risk is limited to the cost of the spread. So let's look at an example of a leg in. AMAT is a symbol for Applied Materials. AMAT was on a prime trade select buy signal. So our brokerage report shows that we bought the 40 strike call at 7.78. We had a $13,000 profit in the trade. So we used our money management rules, and once we have a profit in a trade, then we want to protect that profit in case of a market correction or if the underlying stock goes down in price. So we sold to open at a later date the 50 strike call at 375. So this created an option debit spread that expired about 5 weeks later. And at the time, AMAT stock was trading at 52.48. So we bought to open the 40 strike call. We had a profit in the call purchase. So at a later date, we sold to open the 50 strike call at 375. So if you subtract the premium from the option sold of 375 from the premium of the option purchase 778, you come up with a net debit of 403. So this spread cost $403, and this reduced our dollar risk from $778 to $403. So by selling to open the January 50 call, we increased the profit potential of the call option purchase, and we also reduced our dollar risk from 778 to 403. So with AMAT trading at 52.48, when the trade was initiated, we bought the 40 call, sold the 50 call, so this was an in-the-money spread. And as I mentioned, the in-the-money spreads give us more downside protection and a higher probability that the trade will be profitable. And these spreads can profit if the underlying stock is down as much as 10% at option expiration. So let's look at the debit spread analysis here. This is another one of our calculators, and this will calculate the profit potential for the debit spread, assuming various price changes in AMAT at option expiration. In this example, from a 10% increase in AMAT to a 10% decrease in the stock at option expiration. So we can see that if AMAT is flat at option expiration at 52.48, then the spread will realize a $597 profit and a 148% return. So when you leg into a debit spread, you're going to get higher returns because you already have a profit on the option that you purchased. So in this example, if the stock is flat at expiration, we'll have 148% return. And if the stock was down 10% at expiration to 47.23, we'd have a 79% return. So in this case, if the stock is flat at 52.48 or increases at all at option expiration, we're going to have a 148% return. If it's down 10%, we'll have a 79% return. So profiting when your stock is flat or down 10%, again, will give you a much higher probability of success as a trader compared to just taking directional trades. So we always like to leg into a spread whenever we have a profit on a trade, on a directional trade. We automatically will leg into a spread to protect those profits. Now, selling the AMAT 50 strike call for 375, that resulted in an 80% increase in the profit potential of the 40 strike call purchase. So we bought the 40 strike call, had a profit in that. When we sold the 50 strike call, that increased the profit potential 80% for our 40 strike call. And of course, that also provided downside protection in case AMAT declines in price. Let's look at another example. This is for ISRG, Intuitive Surgical. ISRG was on a prime trade select buy signal. So our brokerage account shows that we bought the ISRG 280 strike call at 45.60. We had a profit in it, and we sold to open the 370 strike call at 15.10. So this created an option debit spread that expired in 5 weeks. And at the time, ISRG was trading at 379. So bought to open ISRG 280 strike call at 45.60. We had a profit in the 280 strike call purchase. So we, at a later date, we sold to open the 370 strike call. And so this was an in-the-money spread with ISRG trading at 379 at the time we legged into the spread. So again, the in-the-money spreads give us more downside protection and a higher probability that the trade's going to work out. So let's look at the profit potential for this trade, and we can see if ISRG was flat at option expiration at 379.24, we would realize 195% return and a $5,950 profit. So that's a pretty good return if your stock's flat at option expiration. That's a pretty good return. If ISRG was down 10% at 341, we would still realize a 101% return. So these option spreads are the way to go. If you have a directional trade and you have a profit in that trade, you don't want to give up that profit if the underlying stock corrects. So we always create a debit spread to protect those profits, and this greatly increases your chances that you're going to be a winning trader. So just to summarize, with legging into debit spreads, the advantages are you increase the profit potential whenever you leg into a debit spread. You increase the profit potential of the existing call option purchase by 50 to 100% or more. And if the we could see in that AMAT spread trade example, when we sold to open the 50 strike call, that increased the profit potential of the existing 40 strike call purchase by 80%. It provides downside protection. If you sell to open a call option, that results in cash being credited to your brokerage account, reducing the cost basis of the option purchase. And then, of course, the short call provides downside protection in the event the underlying stock declines in price. It can reduce risk substantially. We saw on the AMAT spread, it reduced our dollar risk from $778 to $403. And the spread can be profitable if the stock goes up or down. And we saw two examples there where even if the stock drops 10%, we're still going to realize a profit on the spread. So let's next talk about, well, first, I just wanted to mention we have an option trading service, and we make recommendations for debit spreads, and email alerts are sent to members with instructions whenever we have a new debit spread trade recommendation or if an existing trade is closed out. So we maintain a open trade record and a closed trade record, so we account for all trades with our option trading service. And as a member of the option trading service, you get access to those 6 option calculators for the different optioneering strategies. And this is a snapshot, a recent snapshot of the open trade profits for our debit spread portfolio. So we have a debit spread portfolio where we make trade recommendations for debit spreads. And when we took the snapshot, we had $303,000 open trade profit and an average return of 351%. So these debit spreads have been performing well this year despite all the market volatility. And as you saw, we can profit even if the underlying stock declines at price at option expiration. So if you want to get the latest trade results for our various strategies, we have option purchase, we have covered calls, we have option spreads, and we have market neutral or profit guard spread. So if you wanted to see the current performance, you could just log on to weeklyoptionalert.com and click trade results, and that'll show you the current performance for these various strategies. And if you're interested, you can call Brad at his toll-free number or his 310 phone number. So let's now talk about profit guard option spread trades. And Prime Trade Select has produced a lot of profitable call option trades over the years. So when you have a profit in your call option, that poses a dilemma. Do you hold on to that winning call option trade for further upside profit potential, or do you take profits in the case the stock declines in price with the possibility of the profitable option trade turning into a loss? So you always face that dilemma when you have a profit in a call option purchase. So we know from experience that it's difficult to watch a winning trade develop into a losing trade. This is hard on your psyche as a trader and can help you lose confidence in your ability to be a successful trader. So we solve that dilemma by purchasing a put option that provides insurance for your profitable call option trade. So when we have a profit in a call option trade, we'll either leg into a debit spread or we'll leg into a profit guard spread by purchasing a put option. So we trade both types of spreads, and that diversifies our portfolio even further. So again, if we have a profit in a call option, we never want to let that profit evaporate. That's hard as a trader to see a winning trade turn into a losing trade, so we'll create either a debit spread or a profit guard spread. And with the profit guard spread, when you buy a put option, of course, that will profit as the underlying stock goes down in price. So if you have a winning call option trade, purchasing a put option provides a profit guard that can help protect you against loss for your call option investment in the event the underlying stock declines in price. And at the same time, purchasing that put option does not limit the upside profit potential of your call option if the underlying stock continues to increase in price. So with the profit guard spread, your upside profit potential is not limited. So once you initiate a profit guard spread, bad earnings reports don't matter. A severe sell-off in the markets actually produces a windfall profit with this strategy, and we'll show you examples of that. And we don't need to worry about placing protective stops, and you can place the trade and take a vacation. So these profit guard spreads during the recent correction, there was nothing for us to do. Once we purchased that put option protection, in most cases, it guaranteed a profit for our trade, no matter what the underlying stock did. So this is a great way to ride out the correction. We don't care what happens to the underlying price, because in most cases, we can lock in a guaranteed profit, and we just sit on the trade until option expiration. So as you'll see shortly, purchasing the put option protection can even guarantee that your trade will be a winning trade. And purchasing that put option transforms option investing from one of the riskiest investments to one of the lowest risk trades that you can take using options. Now, because there's a long position, the call option, and a short position, the put option, the strategy is also known as a market neutral spread. And market neutral spreads can profit if the price of the underlying stock goes up or down. And a sharp decline in the price of the underlying stock can even result in a windfall profit, and we'll show you an example of that. And your risk is limited to the cost of the spread. You can start out with a small $5,000 trading account, and with the profit guard spreads, we normally go out 1 to 3 months. So let's look at a few examples. The healthcare ETF was on a prime trade select buy signal. So our online brokerage report shows that we purchased the 50 strike call at 9.60. So this was a directional trade. We used prime trade select to select this call option purchase. The trade was profitable, so we created a spread to protect those profits, and we purchased the XLV 50 strike put option at 4 points. So we had a profit in the call option purchase. At a later date, we wanted to protect that profit, so we purchased the 75 strike put. And the 50 strike call option, of course, profits as XLV moves up in price, and the 75 strike put option profits as XLV moves down in price. And again, we have a calculator for the profit guard strategy. So we used that calculator before we took the trade, and we can see that we plugged in the stock price at the time was 71.44. We bought the 50 strike call at 9.60 and purchased the 75 strike put at 4 points. So the calculator shows that if XLV is flat at option expiration at 71.44, we're going to realize an 83.8% return and a $1,140 profit on the spread. So if XLV is flat, 83% return, If it's up 10%, we're going to have 110% return. If it's up 20%, we're going to have a 162% return. So you can see our upside profit potential is not limited. As XLV goes up in price, our profit potential continues to increase. And if it goes down, now we would not expect losses this large, but this just demonstrates the strategy to you. If it goes down 40%, we'll have 136% return, and then if it really crashes, then our profit potential increases the more the underlying stock goes down. So this can actually produce a windfall profit if the underlying stock declines sharply. So again, in this trade example, our minimum profit would be 83%. So that's a pretty good return. And again, once we purchase that put protection, we can just sit on that trade. We don't have to look at it. We don't have to put in a protective stop. We just wait until option expiration to either close out the trade or roll over the trade. So we normally roll over profitable trades, and that reduces the cost basis of the new spread. Here's another example. We use Prime Trade Select to select a brick ETF call option, and the trade was profitable, so we entered we purchased a put option to protect our profits. So the brick ETF was on a Prime Trade Select buy signal, and our brokerage report shows that we bought the 32 strike call at 10 points. So we had a directional trade, selected the trade using Prime Trade Select. BKF moved up in price after we purchased the 32 strike call, so we had a profit in our call option purchase, and then we purchased the BKF 48 strike put option, and this created a profit guard spread. We legged into the spread by purchasing the 48 strike put, and the 32 strike call option purchase, of course, profits as BKF moves up in price, and the 48 strike put profits as BKF moves down in price. And let's look at the profit potential for this trade. Again, BKF is trading at 50.88. We bought the 32 strike call at 10 points and bought the 48 strike put at 75 cents. And we can see that if BKF was flat at option expiration at 50, then we'd realize a 75% return, $813 profit. If it was up 10%, we'd realize 122% return, and our profit potential is not capped if the underlying stock or ETF continues to move up in price. And of course, if it moves down in price, we also profit. So in this example, the minimum profit for this trade would be $525 and 48% return. So we also have a profit guard portfolio with our option trading service, and we send out emails with recommendations for profit guard spreads, and we maintain a closed trade and open trade record so that we account for all our trades. And if you're a member of the option trading service, of course, you get access to the 6 different optioneering calculators that will allow you to calculate your profit potential before you take the trade. Here's a snapshot of open trade profits for profit guard spreads. This lists the option that we purchased, the entry price, the last price, the dollar profit in this column, and percent return in this column. So we have $200,000 open trade profit and an average return of 90%. And with most of these trades, even if the underlying stock went to zero, we would still realize a profit on the trade. So this portfolio, no matter what happens to the markets, this portfolio will be profitable. And again, if you want to get updates on the market neutral spread portfolio, you can log on to weeklyoptionalert.com or give Brad a call at 866-661-5664, and he'll be happy to help you with the service. So again, you can get, if you click the trade results link at Weekly Option Alert, it'll give you updates on how these various strategies are performing. So if you ever want to look at the current trade results for the various strategies, just log on to Weekly Option Alert and click trade results. So that concludes my presentation, and I'd be glad to take any questions.
You ready for some? We just have a
Sure.
couple for you, Chuck. Okay.
Yeah.
We had a couple of questions come in. Carrie asked, can you do this if your account is only $1,000? And then Abba actually asked if you could do it with funds lower than 500. So what is the minimum you recommend for an option account to start trading with?
Yeah, with an option account, if you're just going to do option purchases, I would recommend at least a $3,000 to $5,000 account so that you could have a diversified portfolio of options on stocks in different industries. So we generally recommend at least $3,000 or $5,000 to get started with an option purchase account.
Charles asked, do you ever do credit spreads?
That's a good question, and I analyzed credit spreads versus debit spreads, and what I found out was with the credit spreads, you can collect a small credit, maybe $50, $75 on the trade, but you're risking $500 on the trade. A typical credit spread, let's say there was a 5-point spread on the credit spread, you're risking $500 to make $50, and it works fine until that one time when the stock really tanks, and then you lose $500, and then you wipe out nine or 10 of your profitable trades with just one losing trade. So that that's hard. Psychologically, it's hard to trade. For me, it's hard to trade like that because I don't want to be have 8 winning trades in a row, and then all of a sudden you have a losing trade and it wipes out all those profits. And in this latest market correction, that's exactly what would have happened if you had credit spreads and you were riding the wave up, and you had a bunch of winning trades, and then all of a sudden this correction hits out of nowhere, and it would have wiped out your account. So
Has there been a correction? No, I'm just kidding.
yeah.
We do have a lot of questions about how, if the stock doesn't lose money, how you are still not losing money due to theta decay.
I don't know what theta is. I don't pay any attention to the Greeks. I just
Okay.
I don't even know what it is. I know it's a Greek word, but I don't know what it means.
Yeah. Okay. Somebody's asking how much the options mentoring service is.
Okay, that varies. That varies on which program you get and length of time. But if you call Brad at this phone number, he'll be glad to give you that pricing.
Okay, if my investment capital isn't available yet, can I take advantage of today's bonuses and benefits when my portfolio permits? I think you're talking about the bonuses that you signed up for when you were registering, and while, yeah, absolutely. The way that that's going to work is what we're going to do is on Monday, you'll get emails for the bonuses that you subscribe to and how to take advantage of those. We have one last question. I'm sorry if we missed any of these questions, but somebody wants to know if your calculators are proprietary, but they're part of the service, right?
Yes, if you're an advisory member or a trading service member, then you get access to all 6 calculators.
Okay, all right.
And
I think
as far
that's
as I know, there is no other calculator out there that does what these calculators do.
okay. Very good. I think that's the questions that we have time for. If you guys have other questions that we didn't cover today, give Brad a call at 866-661-5664, and he'll do his best to answer those for you. Chuck, I want to thank you for your time, and thanks for coming in today.
Okay, thank you, Jeff, for organizing this. I always enjoy participating, and I appreciate the offer to participate today. And I hope everybody has a great day.
All right. We did have one question that came in earlier that I'm going to actually answer about how you can potentially find stocks to throw into these calculators and how
Right.
that works. Obviously, that's part of the alert service. So if you subscribe to the alert service, I think you send out recommendations on exactly what stocks you should look at. You can correct me if you're wrong, or if
That
I'm wrong.
that's correct. Yeah.
All right.
Yes, we use
I'll
Prime
show
Trade Select to select the trade.
I'll show how you can use MetaStock to find those as well.
Okay.
In any case, thank you very much, Chuck.
Okay.
I really appreciate it. You always do a great job. I love the simplicity of your model and really how well it works. So really appreciate your coming and sharing a little bit with us today.
Yes, thank you, Jeff, and I appreciate the offer, and I enjoyed participating today.
Okay, awesome. Okay, so I want to talk a little bit about how a few years ago, Chuck and I sat down together, and we put together a really good way to actually find these stocks. With the Prime Trade Select methodology, what it's looking to do is it's looking to determine the price trend. It's looking to confirm the price trend, and then it's looking to determine a low risk entry point. We're going to go a little bit long, but it's okay because I'm the next speaker, so we'll go straight into that from here. So the way that Chuck actually determines the price trend is he uses here's the goals behind that, which we'll just skip ahead. He'll look for stocks that are where their 50-day exponential moving average is specifically above their 100-day exponential moving average. That's when he considers a stock that's in a bullish zone. Okay, you can see this on a chart. You've got your 50 and your 100. As long as it's in this area that's between that 50 and 100, you're basically going to be in a bullish zone. So, and obviously we want to trade with the trend. So that's the way we determine it with the Chuck Hughes model. Okay. The step 2 that Chuck designed is he's going to confirm the price trend. And this is also very, very simple. He's basically going to look for a stock that has traded at a new 52-week high in the last 6 months, and he's going to confirm that with on-balance volume that is higher than it was 6 months ago. Okay, so that's what he's looking at. There's a chart of the 50-day, the 100-day, and the OBV sloping up. Once it's met those conditions, what he's going to look for is he's going to look for a low risk entry point. Okay, and the way he does that is using Keltner channels. Okay, here's a little bit of a definition of Keltner channels, but what we're looking for is we're looking for a pullback into the mid zone of the Keltner channels or to the lower band. Okay, and so here what we're looking to do is we're looking to buy when it's at the middle or the lower channel. Okay, now this is all automated for MetaStock. So if we come in here, and I'm going to swap over to MetaStock. I think I have a few too many charts open. You'll be able to kind of see a chart. I ran this scan today, and this is where it's actually fresh pet. But you'll notice that what we've got is what you're going to find is you'll find stocks that are currently in an uptrend that have had a 52-week high in the last 6 months and have pulled back to a Keltner channel. Okay, and to show you how that scan runs, we'll just go into the scanner again. I've got the Chuck Hughes scan right here. We'll scan it against the pre-filtered list. And of securities, it's about 2,500 of the optionable securities. Oh, I'm running the top dog again as well. You'll notice it's going through, it's going to reject about 98% of the stocks. Okay, so out of that list of 2,500, what we're going to be looking for is any of the stocks that have set that 52-week high, are in an uptrend, and have pulled back to a Keltner channel. So, and here's kind of how the results come back. Very, very simple. It's almost done. Just waiting for it to post the results. Here's what you're going to see. Okay, so this is an example of one we found today. The rest of the methodology that he uses is also very, very simple as well. So in terms of the stop placement, he's got 3 different stops that you're going to use. You're going to sell a stock if it closes 10 to 15% more below where you entered it, and you're going to use a 25% trailing stop. Okay. And the other type of a stock, I'll just show you in the software, okay? Because this is all listed in the software. One of the things that we want you to be able to do is be able to implement this and not have to go through a video. And so we do our best to actually explain exactly what we're looking at. So let's go ahead and look at FreshPet, the chart that I've got open. What we've got is it's pulling back to its Keltner channel. It's at the middle line right now. So this is an entry pattern. Anything that's on the chart as a blue bar is actually an entry, a place where you could enter, okay? So it's going to automatically do this, determine the price trend, confirm the price trend, and determine an entry spot. Here's your suggested exit guidelines on this. So you'll sell if a stock it closes 10 to 15% more. You'll use a 25% trailing stop. You could look to sell a third of the stock position if the stock increases 30% above the entry price. You'll sell another third if it increases 50% above the entry price, and you'll hold a third of the position until it actually exits out because it closes below its 10-month simple moving average. And these are all kind of automated for you, okay? The third type of a stop loss that you'll use with this is you'll sell the stock if it goes 10 to 15% more down. Then this is all automated, so assuming we would have actually bought right here, it's gonna actually show you where, or that we bought right here. It's going to tell you to sell a third of that position here, another third of the position here, and it hasn't closed below that 10-month moving average, so it hasn't told you to get out. You do have another buy entry that's generating all through this area, another buy entry here. So to answer your question, that's how you find the patterns. Very, very easily. Open up MetaStock. It'll run through that for you, okay? Ravi asks, is MetaStock membership needed for the Hughes Optioneering? No, definitely not. So there you go. Ian asked the question, what is the difference between Keltner channels and Bollinger Bands? It's quite a bit of a different calculation. With Bollinger Bands, it's a volatility adjusted channel. With Keltner channels, and let's just see if I can look at the, well, I'm trying to remember how those are actually calculated, but they're not the same calculation. They're quite a bit different. I'm not really prepared to talk about the difference, but I can tell you for certain they're not the same thing as Bollinger Bands. Okay. All right. So there we go. We'll kind of go through this just a little bit. Okay. And we actually have 2 versions of the Prime Trade Select system. We've got a basic and a high probability. We have 2 matching expert advisors. We have the explorations that are included with that. It's been a very, very popular add-on, and I'd say largely due to the fact that Chuck Hughes is so popular and he does such a good job with his investment services. So we do offer this as a one-time cost, $399. It does come with a 30-day money-back guarantee, and it is also part of our 4-pack. So you can get Price Headley's, Vince Vora's Veracity, Barry Burns' Top Dog Trader, and Chuck Hughes Prime Trade Select. Normally those would be about $3,143 total. The Price Headley, that includes, since it's a monthly subscription, that includes 3 months of the subscription. You'll get, if you do this, you'll get 2 years of stocks and commodities, that'll be included. You'll get 3 months access to our MetaStock real-time program, 3 months access to our MetaStock Zenith, and a course that's going to help you get everything installed and running. We also do offer a new service that's been very popular with our new users. We call it a white glove installation support call, and our sales reps will help you get set up for that when you're talking to them. In any case, the normal price of this would be like normally $4,138. Here at the special today, or here at the summit today, as a special, we're actually offering that for $1,796, all of that. So give us a call at 800-882-3040 or visit metastock.com/sales chat. Okay. While we're looking at that, I'll just see what kind of questions. We do have a little bit of a more relaxed time right here. So let's see what kind of questions are coming through. We'll take a couple of those. And give me just a second here. Okay. John answers the question for you. BB uses standard deviation from a moving average. Keltner uses average true range from a different moving average. So there you go. I'm going to send that to the whole group. John, thank you. One of the other things is you can go look at the calculations. I find Investopedia.com is a terrific website to go and look at just about anything you want. SP says, Jeff, can one select an individual add-on instead of the complete toolbox? Yes. What we're doing, if you're just kind of interested in maybe the Chuck Hughes one or the Veracity, or we have a discount on for Barry Burns and Chuck Hughes. It's a discount of like $100, so $399 for those ones. If you want to do the Big Trend Toolkit, we'll still do $49 for 3 months. With Vince Veracity, we're actually offering that at $999. So you can get you can get the whole toolbox if you want. If you're interested in just one SP, you can absolutely do that. And thank you for your interest in the add-ons. Okay. Well, it says, so the initial investment is $17.96 and we're needing actual investment capital and the broker fees, correct? That's actually not true. You obviously need an account somewhere, but we don't do trading. We're not a brokerage account. What we do is focus on tools that's going to give you the best way of finding the right trades at the right time and the right strategies. So, and I'm going to talk a little bit more about that, but I do want to point out we don't do brokerage. For the last 25 years straight, what we've really excelled in is giving you a good decision support tool. Okay, but yeah, obviously you'll need a brokerage. You can use whatever brokerage you want. You don't have to give us 20 or 30 grand so you can open up an account. That's not kind of what we do. We focus on creating the best tools in the market. Okay, you're welcome, Walt. All right. Before we get into kind of my talk, I do want to thank Stocks and Commodities Magazine for sponsoring today's event. You'll get a free copy of this as part of coming today. And if you do take advantage of that Traders Pack, you'll get a 2-year subscription. Okay, you can claim your free issue. I'll repost that in the chat in just a few minutes here. So let's talk a little bit about me. Yeah, I'm going to jump off of this real quick, but I do want to just talk a little bit about MetaStock as a company and kind of our heritage and our history, and just kind of give you an idea of what MetaStock. I'm not going to spend a lot of time on it, but I like to talk a little bit about kind of where we come from. So just to let you know who I am, my name's Jeff Gibby. I've worked for MetaStock this year. It's 21 years straight without I love working here. When I started in inside sales, so I talked to traders all day long. I did that for about 13 years. We'd talk about kind of like how they were looking to improve their trading and talk about MetaStock, et cetera, et cetera, et cetera. It was great. I enjoyed that. I think I just said I did it for 13 years. Let's make that 9 because it's more accurate. I did that for 9 years. For the last 13 years or so, up until just recently, I was in charge of our business development here. And that's, as part of that role, you know, that's how I worked with Chuck Hughes and Vince Vora, everybody that we featured here today. And I've done a lot of work on kind of the add-ons as well. But it was a great job. I very much enjoyed it. I helped a lot of our dealers did a lot of traveling. Just recently back, maybe a couple months ago, I became the director of sales. So now I'm in charge of our entire sales staff. That's been fun. It's kind of a little bit refreshing to do something a little bit different after 13 years. And it's been a lot of fun. I don't know that I'm any good at my job yet, but we're working on getting there. So when I started with MetaStock, it was way back, 21 years ago. We're wholly owned by Reuters. We have a great relationship with Reuters, and we just bought ourselves back from Reuters in 2013. But we still have some great advantages from that Thomson Reuters relationship. And the biggest one is our market coverage. So, I've answered a lot of questions that you guys have had. Can I do this in India? Can I do this in London? Can I do this with foreign exchange? Can I use ETFs? One of the things about the fact that we get all of our data from Reuters is we actually cover about 200 different exchanges. If you're not familiar with Reuters, it's a $19 billion a year company. 90% of the revenue they actually generate is selling real-time data to like brokers and banks and hedge funds, and that's the other advantage we have. A few years ago, they spent over $1 billion to design a competitor to Bloomberg, and they call it Icon. We call it MetaStock Zenith. If you're familiar with Bloomberg, I believe the retail price on that is close to $2,000, and that's what you pay per person, per institution. With Thomson Reuters, it's not quite as expensive, but their pricing for Icon, I believe it starts at $750 and it goes up from there. With our relationship with Reuters, if you have MetaStock real time, you're going to have a product called MetaStock Zenith. And with MetaStock Zenith, it has real-time news and information from Reuters and all kinds of global information that you can go and look at. They support it with, the numbers are just crazy, 3,000 full-time reporters in 300 different news bureaus. By far, that MetaStock Zenith platform is one of the best sources of news and information, particularly because here at MetaStock, the pricing on it starts about $99 a month instead of 10 times that. So, the point is we have a pretty good relationship with Reuters. It's been advantageous for us, and the services that we have are very, very good. Let's get on with it though. So we're going to talk a little bit today. The last thing I want to say about MetaStock as a company to work for is a great company. I'm very proud of the way we take care of our customers if they have questions or concerns. A week doesn't usually go by where I'm not hearing somebody talking about how they talked to Heidi and had a really good support call. One of the things that I'll mention before we talk about system testing is the fact that we have actually more people in support than we have in sales and marketing put together. So I'm really happy that I've been here for as long as I have. I'm not bored, and it's just a great company to work for and a great company to represent. So, and like I said, 25 years in a row, it's been rated #1 in the Stocks and Commodities Reader's Choice Awards. So